VTSAX, or Vanguard's Total Stock Market Index Fund, is arguably the flagship index fund, the rallying cry, the Swiss Army knife of the financial independence retire early community, also known as FIRE for short. In this video, I want to walk through the basics of VTSAX, why it is so popular with the FIRE community, and some things to consider if you're looking to achieve early financial independence. If we are meeting for the first time, my name is Sung and I'm a husband and a father to 3 wonderful kids. On my channel, I love talking about personal finance tips and strategies that have helped my family grow our wealth in our journey towards financial independence. If you too are wanting to grow your family's wealth so that you can focus on what truly matters, be sure to subscribe so that you don't miss out on anything. A few weeks ago, I talked about VTSAX and 3 other Vanguard funds and why they are such a great investment if you are looking to simplify your investment strategy with as minimal work as possible. I'm going to dive deep into VTSAX, but a lot of what I'm going to talk about also applies to the other low-cost index funds and ETFs like VTI, VOO, and VFIAX. Before we go any further, I am not a financial advisor and this video is purely for educational purposes. I recommend you do your own research and speak to a financial advisor if you think it's necessary before you make any investment decisions. If you're not familiar with what an index fund is, it is basically an investment fund that tracks a particular market indicator such as an S&P 500, which is by far the most popular of all. The fund in a nutshell buys the stocks of the companies that make up the index that it is trying to track. In many cases, like VTSAX, larger companies take up a bigger portion or share of the fund, and smaller companies take up a lesser portion. This is all based on the market value of the companies, which is basically how much the company is worth, and that is again based off of their stock market price and their volume. Now, VTSAX specifically follows an index called the CRSP or CRSP US Total Market Index. You may be thinking, what the heck is CRSP? Well, it stands for the Center for Research in Security Prices, and that's a nonprofit data provider that's affiliated with the University of Chicago's Business School. This CRSP index is made up of almost all the companies that you can invest in, mostly from the New York Stock Exchange, or NYSE for short, and the NASDAQ. Now, I say almost all companies because there are some really tiny publicly traded companies that are not worth including into the index because of their stock price and their volumes. And if you are unfamiliar with what the NYSE or NASDAQ are, these are the biggest stock exchanges in the United States and in the world. Trillions of dollars worth of stocks of the thousands of the most popular companies are traded on these 2 exchanges. By tracking the CRSP index, you may be wondering what exactly does that mean for the VTSAX index fund. Now, here I am on the Vanguard website and looking at the page regarding this fund. If we go down to portfolio here, this will show us that there are just north of 3,600 companies that are part of the fund, and for the benchmark there's around 3,500 plus or minus 62 companies. So that's just showing you the number of companies that are in this fund, and it's pretty consistent with the benchmark, the CRSP index. If we go further down here and under compositions, the sector weightings, this shows us that technology companies make up north of 20% of the fund, that financials makes up just under 20%, consumer services under 14%, and as you go down the list, these cover most of the broad sectors of the economy. And so you get a very broad distribution of companies and sectors in this fund, and which totally makes sense since this is a total stock market index. Now, if we go down further, we can look at the actual companies, all 3,600 companies that make up this fund. And again, here you see that Microsoft is at the very top in terms of the proportion of the funds for this company, and then Apple, Amazon, Facebook, and then Berkshire Hathaway. So it's a very technology heavy, financials heavy fund, and it's reflected in some of the top holdings here that you see. So I'm going to link to this website in the description down below so that you can explore further and just do your own research on this fund. Now, I'm going to scroll back up here to look at the fees and cost. Actually, let me go further up here. Now, this is something that I talked about in my previous video on the best Vanguard funds. And if you haven't seen that video, I'll link that in the description below, as well as in the top right here. But you can tell that this is a low cost index fund simply because the expense ratio is incredibly low at 0.04%, which is definitely not the lowest, but it is extremely low, which is a great thing because that means that will save you money over the long run. And we know that this is also an index fund simply because if we read the objectives here and this investment approach, it clearly states that it's tracking the performance of the CRSP US Total Market Index. If you're finding this video helpful so far, be sure to hit that like button down below, and make sure if you have any questions or any suggestions, be sure to add that in the comments as well. When it comes to investing, diversification like that which you get with the VTSAX is really important. Because if you're only investing in one company and the company does really poorly or it goes out of business, that's a very quick and easy way to lose your shirt, so to speak. There are always exceptions to the rule, I suppose, but unless your name starts with Warren and ends with Buffett, trading individual companies with a lot of money is just not a good idea. If you plan on doing so, make sure you don't expose yourself to massive losses by keeping the pot of money at play very small. As for the vast majority of your investable money, I recommend looking into funds like VTSAX so that you get instant diversification and you minimize the chance of losing all your money. The diversification across more than 3,600 companies makes VTSAX one of the best tools to grow your wealth in the stock market over the long term. It's simple to understand, so you can be comfortable knowing what you are putting your money into. It's also very passive, probably as passive as it gets, considering you just open an account, you dump your money into it, you buy the fund, and you just watch it grow. And it costs very, very little compared to other investments like mutual funds or even rental properties. That being said, in the short term, there's a good chance that you might lose money. But if you stick with it in the long term, the market has always bounced back higher than before. Here we are on Yahoo Finance, and we're looking at the S&P 500. And here, starting in 1950, I want to demonstrate to you just how much the market grows over the long term. And so in 1950, it is starting at a value of 1650-ish, around here, 16, 17. And if we keep going to the right as the years progress, I mean, you notice that the trend is just going up. Obviously, there's these dips and just short-term volatilities all along the way. But as we keep tracking right and going, getting closer to today, you'll notice that the value of this index has just increased so much, even over just a period of just a couple years. And as we keep going, here's the dot-com bubble from the early 2000s, and here is the financial crisis from 2009. And now if you see where we are at in 2019, you see that we are at about 3,000 compared to just 1670 years ago. And from 2009, which was around, let's just say it was 770, this is almost more than 4 times increase in the value of the market over a period of 10 years. And so this is the reason why you need to be invested in the market through funds like VTSAX or other diversified broad index funds. Again, VTSAX does not track the S&P 500, and I was just showing that as an example. However, the fund does include the 500 large companies that are part of the S&P 500 and an additional 3,100 small and medium companies. So you can guess that there is a ton of overlap. We're back here on the Vanguard website to illustrate my point that with the total stock market index, you'll get basically the same results as the S&P 500 that I had shown you earlier. Here we were comparing the VTSAX in blue with the S&P 500 index over the 10-year period, and this is basically, we're just looking at hypothetical growth of a $10,000 investment, and you see here that the lines basically are on top of each other, and so you really can't go wrong with an S&P 500 or a total stock market index. They're going to be very, very, very similar, and really the difference here is in regards to the small and mid-cap companies that are not in the S&P 500 but that are in the total stock market index, that those small differences are because of that. So why is VTSAX so popular with the FIRE community? Well, other than the reason that I mentioned, such as the simplicity, the low cost to invest, the passive approach to it, I think the popularity really originated with the granddaddy of the FIRE movement, J.L. Collins, and his formative book, The Simple Path to Wealth. If Vicki Robbins is the grandmother of the FIRE movement, then I consider J.L. Collins to be the grandfather of the movement. And that's totally my personal opinion based on what I read and did not get sidetracked. But they were both financially independent and retired early, decades before even the concept or the term FIRE came about, much less the movement or even the community. J.L. Collins was a big proponent of Vanguard and the VTSAX index fund, and I think that preference echoes in the FIRE community today. The empirical, the facts and data-driven conclusion really resonated with the FIRE community. That is the conclusion that holding the entire US stock market at a low cost and passively will give you a historically better performance than holding an expensive actively managed fund. That being said, you need to do your own research and come to your own conclusion of if or how VTSAX is going to fit into your family's wealth building strategy. This is where personal finance gets personal, and nobody else is in your situation with your needs and your goals. Now, I want to share 3 things that will help you think through this next step, and it's based on my family's experience and how we've incorporated index funds into our financial independence strategy. First thing is that the average annual stock market return that you should expect from VTSAX is around 6 to 8% after inflation. Now, some people might argue for less, some people might argue more, but I would argue that the general consensus is within that ballpark. By investing in VTSAX, that's basically the return that you can expect. Some years you'll have losses, some years you'll have gains, but that's just the nature of the stock market. You have to accept the volatility and have the discipline to stay in the market if you want to see results from an index fund. Second thing is that VTSAX gives you a minimum standard by which you can compare other investment opportunities. In other words, consider the 6 to 8% return you can get from VTSAX as a benchmark by which you could compare other investment opportunities that come your way. For example, if you decide to invest in rental properties, you want to make sure that the total returns on your investment, that includes appreciation, your cash flow, the debt pay down, the tax benefits, that all those things added up together will give you a return on investment of greater than 6 to 8%. The third thing is that trying to achieve financial independence with index funds alone is without dispute the easiest and probably the most passive way of growing your family's wealth. However, I would argue that it is the slowest and probably the most capital intensive. It's important to not just be diversified within an asset class like stocks and bonds, but also across different asset types. So my family does own broad index funds in our retirement accounts, but we also own a big chunk of our investments in rental real estate. It is my family's experience that rental property investing has gotten us much closer to financial independence than if we had put all our capital into index funds. Rental properties do take work, but if it is done correctly, it can set up your family for financial independence much earlier and with much less money than you would think. If you enjoyed this video, be sure to share with anyone who you think it might be useful for. And if you like this video, be sure to hit that like button down below and make sure to subscribe so that you don't miss out on any new videos. Thanks for watching, and I'll see you next time.